And this is now indicating that we are being recorded. It'll take a couple hours after we end our session to actually process this and put it up on Blackboard, but you can come back and refer to it at any time in the future. Well, first and foremost, welcome. A brief overview of the course is that I break it into what I consider to be 4 conceptual models. Those modules are in your course content folder in Blackboard course container, listed as introduction, which is a broad view of the financial marketplace. And then yields, which deals with a lot of the calculations having to do with the various instruments that we may discuss, review, and read about in the first segment, the first module. A lot of those math examples, whenever we see them covered in a PowerPoint or some other posting or any video that you're suggested to look at, examples of those are also provided with different numbers, different setting on the Blackboard course container. But at any time, when a math issue in any way confuses you or doesn't make sense, or somehow you're not able to get the same answer that was suggested, you can certainly contact me and we'll go over whatever the problem might be and try and resolve it so you can see how the math might be done. Then I would be sending out the first exam of the 2 exams, covering Module 1 and Module 2, the basic overview of financial markets and institutions, and then the yields. After the exam, we would begin Module 3, which has to do with our central bank. And our central bank is, of course, known as the Federal Reserve. And Module 4 discusses some of the management issues that any manager of any financial institution has to face, has to consider, has to come up with some type of management decision on how to benefit the firm given the risk involved. Now, when we look at those risks, we'll usually take a balance sheet approach, and we'll use a commercial bank's balance sheet as a typical way of trying to organize the risks that financial institutions take. But off the cuff, at the moment, you would basically say one of the primary issues is liquidity. It is very important for the banks and other financial institutions to meet their ongoing commitments, to meet their bills, to give people their assets, their currency, their deposits, their coverage, whatever it is that they're committed to providing their customers, that must be provided generally on demand when the issue is occurring. And for that, they have to provide liquidity for themselves to be able to meet those commitments. But the more cash you have on hand, the less you have invested. And therefore, your profitability goes down as you increase your liquidity. And of course, each of these institutions are organized predominantly for profit. And as such, they're expected to make a decent profit to pass on the returns to their individual investors. So that's the primary trade-off, is between the liquidity, the safety of the operation, and the profitability of that operation. when we look at the balance sheet, the cash and securities that most financial institutions hold should be held to meet either actually required reserves or planned reserves that provide that liquidity. Then you have the asset mix, which is where are they putting everybody's money? In what investments, in what assets are they investing? That mix can have various levels of risk. Washington Mutual in 2007, 2008 had placed too much money in high-risk mortgages. And therefore, when the high-risk mortgage market, which was very small relative to the overall mortgage market, when that market crashed, Washington Mutual went into crisis. So every institution has to be careful of the asset mix that they are holding to make sure it's adequate for the risk that they should be taking. On the flip side of the balance sheet, you're always concerned about the debt level, where that debt level is maintained, in what form is that debt. As you and I, if we take on too much debt and we're using our MasterCard to pay our Visa card, sooner or later we know we're going to get into trouble. And every institution is in the same situation. If they're borrowing from one to pay off some borrowing from another and just building more and more and more debt, sooner or later that debt will bury them. Lastly, you have the equity portion. And for a lot of financial institutions, especially banks, there are equity requirements. And that equity requirement is usually a minimum for most institutions. Managers tend to be more cautious, and therefore they would like to hold the adequate capital necessary to maintain a good performing institution. So we'll come back to the management of the issues facing various financial institutions later in the course. Meanwhile, you know that there's quite a few articles out on the Federal Reserve itself and the current conflict between our current president and the operation of the Federal Reserve. So the essay associated with your first exam, which you should read up on as soon as possible and start to craft as you choose, looks at the Federal Reserve and its independence. So the first step in writing that essay is to make sure you understand what Federal Reserve independence means. And that expression of its independence and what is meant by it should be in your first paragraph of your essay. The second and third paragraphs of your essay, and it doesn't matter which order you wish to present, that's fine. One paragraph should address the pros, the arguments in favor of Fed independence, and the other paragraph should express arguments that are opposed to Fed independence. Within those paragraphs, try and identify what might be considered truly valid arguments in either case, and have that argument supported by somebody of note in our society. It could be a politician, could be a famous economist, could be a well-known author, could be whoever you wish that has expressed a clear explanation and support for the position you are taking in that paragraph. The fourth paragraph is simply your conclusion from having done the research and what you think should be true. Now, whatever you decide and place into that fourth paragraph is not right or wrong, as long as it has been supported by your argument in the previous two paragraphs. One of the issues we will talk about when dealing with the Federal Reserve, our central bank, is that it is the only central bank in the world that has what's referred to as a dual mandate, which means its charter currently requires it to consider both inflation and unemployment as targets for monetary policy. There are those, and there were theorists like Phillips back in the 60s of the previous century, who argued that this was a trade-off, that to have lower unemployment, to create more jobs, you would have to have higher levels of inflation. On the other hand, to bring inflation down, you would need to restrict and therefore limit growth and hurt job creation and lead to higher unemployment. So there was, in that theory, a trade-off between inflation and unemployment. Of course, we have lived through, since that theory was first suggested, periods of both rising inflation and rising unemployment, rather than a trade-off, and other periods where we had lower inflation and full employment. So if there have been periods where there has never been a trade-off during those periods, either on the upswing or the downswing, then the theory doesn't always hold. And other theories have evolved since then. So there is a posting on Blackboard and listed in some of the documents that I have provided, where is a reading that you should do that talks about the three types of inflation. As such, you have plenty of time, so to speak. Concentrate on the central bank first. But the second essay, which is associated with the second exam, which is due at the end of the term, is asking you to relate the theories associated with the three types of inflation with the current political, economic issues going on between the Fed and our government and our society at the moment. When we talk about the yields, then we're talking about all the ways that we need to calculate the return, the interest rate associated with the various instruments that are in the marketplace. And your readings begin with chapter 6 that talks about money market instruments, and then chapters 7 through 10 that discuss capital market instruments. Now, for some of you, especially the capital market instruments, it's going to be repetitive because this is not your first course in finance. For others of you, if this is near to the first course in finance you've taken, then this might be relatively new to you, unless you happen to be a participant in one of those marketplaces, either through work or as an investor. So let me explain. The capital market, the two primary issues that people think about are, of course, bonds and stock. But the mortgage market is also in that capital market as well, as is Treasury securities that are longer term by nature, usually referred to as Treasury notes and bonds. Basically because notes have a maturity of 1 to 10 years and bonds have a maturity of 30 years or longer. Nevertheless, what many people find to be relatively new information is in Chapter 6, which deals with the money market, which has a good 6 to 8 major players, instruments that are available for companies, corporations, financial institutions, as well as people to utilize for their individual purposes, whether it be for financing or for investing. And that might include things like commercial paper, bankers' acceptances, or from the government bills, treasury issue known as bills, where you have cash management securities, CMSs, that are only 25 days in length, or you have treasury bills that are usually 91 or 182 days. And most people think of that as bills that are issued for a quarter or bills that are issued for half a year. Nevertheless, when it comes to the math, then we have to calculate the yield associated with those instruments, whether they're in the short-term market, the money market, or in the long-term market, the capital market. And if it's in the short-term market, then we often need to annualize that return so it's directly comparable to all other interest rates that we've calculated in the capital market. Generally speaking, when we talk about interest rates, we talk in terms of the annual return. And it is the annual return that we want to make sure we're calculating correctly and including any issues that might impact that calculation. But you'll come across that as we go through the various math issues in time. That brings us back to our first module, which is the introduction, the overview. And herein, we're just going to introduce you to the instruments in the money market, the instruments in the capital market, the major institutional players that are out there, some of the changes that have happened in our modern period. Now, the modern period is usually from World War II on, so that's the 1950s to our current situation. That's about 75 years. But we also find that we will see in our discussion that the new century is very different than the last portion of the old century. So these 25 years in the 21st century, there have been many changes that occurred due to laws that were introduced in the last part of the last quarter of the 20th century. So from 1975 to 2000, many different laws were passed, most in the late and mid-90s, just before the turn of the century, that set a new stage for the 21st century. Some people believe that many of those laws that deregulated the environment set the stage for the Great Recession, the crisis we had from late 2007 to 2010. Now, it's called the Great Recession because the market lost a tremendous portion of itself, eventually 30%, in a very short period of time. And that began in the last quarter, around October of 2007, and didn't hit bottom till mid to late 2008. And then it took all of 2009 and 2010 for us to recover to where we had been prior to the crisis. So that's why the Great Recession is referred to as 2007 to 2010. Some people only discuss 2008 because that's the period in which we had the fall, except for the initial shock in October of 2007. Now, compared to the Great Depression, the same general occurrence occurred. It was the end of the year October, November into December, that we had a major crisis in the market. And then it persisted in the following, not year, but years, 1930, 1931, 1932. Not until 1933 did it bottom out. And then it took from 1933 until 1940, 7 years before we recovered as a nation to be having a market that was back to where it had been prior to the crisis. So that's why it's called a depression, because it lasted so long and had declined so far, nearly 40% of its value having been lost. And comparing our period of 2007, 2010 to 1929 to 1940, since it was slightly less of a decline, and I would imagine, I would consider it significantly less time involved, though still longer than any general recession we have, then we would generally call it the Great Recession because it was significant, especially compared to other recessions that generally occur every 5 or 6 years. So that's what you'll be looking at the various postings in Blackboard. When you go to Blackboard and under course content and into a module, and you see a PowerPoint presentation, it highlights, but might also extend what you might be reading from the chapter indicated to go along with that concept area. Just below it, you would also find a commentary. So slide by slide is written what I would generally say to you if we were together in a classroom. So if you have the opportunity and able to split your screen, you can look at the PowerPoint slides on one side and the commentary on the other side, and pretend to hear my voice as you start to read through both the PowerPoints and the commentaries. Another major issue for the course is going to be the individual assignments that you're asked to complete. There are 5 posted, and each one is explained in some detail under assignments in the Blackboard course container, and mostly involves online internet searching for reliable sites that provide the necessary information to provide solutions and or responses to what you are requested to do in the various assignments. Now, the 5 assignments are posted in order and go along with the topic areas that we discuss in the course. So the 5th assignment is associated with that last module, the management of financial institutions and their perceived risks. But you can do any one of them at any time throughout the course. I would suggest that hopefully you do some of them, or at least one of them, early on, so that you're not waiting to the end to complete both that assignment, do the group project, and be prepared to take the second exam. I mentioned to you that there's always the use of FRED. That's F-R-E-D, capital letters. And that's the Federal Reserve Economic Data Bank, provided by the Federal Reserve District Bank in St. Louis. The first time you use FRED is going to be difficult. But once you get used to using the site, you'll find that it contains enormous amounts of information. It's not the only source, though. Each of the Federal Reserve District branches specialize in a particular area of research and provide their own research, as does the Board of Governors, who operates the management of the Federal Reserve System. So as you go through the 5 assignments and read through them soon, you might see which seem to be most reasonable for you to address. And then as we get to that material, it might be more easily completed. But those are all online type of assignments. Lastly, there's the group assignment. Form a group, be 5, 6 of you together, just as long as you share the work. You're to pick a financial institutional type, such as a commercial bank, or a thrift, or a life insurance company. Now, I'm not saying necessarily that you want to look at Citibank. What I'm saying is that you want to look at commercial banks in general, but you could definitely use Bank of America as an example. What you want to do is see how that particular institutional group, maybe exemplified by a particular institution, performed during these 3 most recent downturns in our economy. And all of that is explained in the document on Blackboard to remind you what it is you're trying to achieve. But the work involves not only a research paper summarizing what you learned about these risks that the institutional type took and how it performed during those 3 periods, but you want to highlight anything unique that you learned about the institutional group, as far as maybe any laws being passed or any restrictions on its operations or any major event that may have happened to that particular grouping. To aid you, once you've picked an institutional grouping, there are chapters at the end of the textbook on each of those institutional groupings. One group, one institutional type. So the first group that is formed and claims an institution, I will let everyone else know that that institutional grouping has been claimed, and the next group must claim a different institutional group. Now, the institutional groupings are listed in your syllabus along with the chapters that are associated with that particular institutional group. And that gives you necessary background to understand the institution, what you're looking at, what you're perhaps looking for when you go to see the data necessary to evaluate how the firm has performed during 3 challenging periods and how that institutional grouping may have faced some major event in the past, say, 20 years. When you do the planning for your group, perhaps you want to assign somebody to then summarize what is found and placed into a PowerPoint presentation that you must send me so I can post it to Blackboard so everyone else in the class can peruse the work that you did quickly to get an insight into some of the activities associated with a particular type of financial institution. Then at the end, when the last exam is being submitted, you are asked to also submit, Vincent, I'll be right with you. You're also asked to submit an evaluation of your peer. So you list everybody and you give them a score between 0 and 5. No to full cooperation, communication, contribution. So if somebody is fully cooperating and staying in communication, and adds to the data, helps contribute, you give them a 5. But if somebody flakes off and doesn't do any of the work, then you really should evaluate that person accordingly. Vincent, did you have a question?
Hey, are you assigning the groups, or do we like how do you want us to go around that?
No, I'm not assigning the groups per se. I'm asking you to form them yourselves first. And then if you have any difficulties or you want me to assign you, I will then step in. But
Hey,
at first, I'd like you to try and form your own, because that forces you a bit to communicate with each other. It's
so
very hard to build
how
up
do
any
we
network when you're so remote. Hmm.
that's true. How do we find everybody's like contact information or who's in the
Okay,
class?
so the email I just recently sent to you has everybody's email.
Oh, fantastic.
But also in Blackboard, there's a discussion board that is one of the folders posted to your Blackboard course container. And
Yeah.
if you open that up, you'll see maybe I've already created about 5 discussions. One of those discussions, you're encouraged to discuss the group. First forming the group. Hey, I'm available. I know I work at a commercial bank or something of
Yeah.
that. That's and just see how you do for the first week or so. See if you can get a group going.
How many you want a group? 5?
5 to
6?
6. Yeah,
Okay. Thank you.
you're welcome. Danny, you have a question?
Yeah, how should we be submitting our group members and our topic to you?
To me, everything comes via an attachment to email.
Okay,
That I find to be the least challenging for me in trying to keep track of everything that you're doing.
thank you.
There any other questions having to do with have I covered all the basic requirements and expectations?
I was gonna ask about the PowerPoint that you were saying. Um,
Correct?
so just just one PowerPoint for the whole group, right?
Correct.
Okay. So
So one
how
person may, I'm sorry, go ahead, Elaine.
so just a PowerPoint at the end, like summarizing pretty much what we have in the paper, like that you're gonna post for everyone to see.
Exactly.
Okay.
And really, you don't need the detail that might have come out of the chapter in the book. What you want to is highlight what you found.
Okay.
I had a question about the exams.
Yes.
So these exams are in addition to those 2 essay assignments.
The essays are part of the exam.
So what is the rest of the exam?
Well, multiple choice, problems,
Okay.
filling.
And how early will those be issued to us?
If you look at the calendar, and hopefully all the dates are correct, um, usually on a Friday, I send it out, and it's due back that Monday.
Okay. Thank you.
Are the
Now, generally speaking, I'm sorry, but some people they ask if I can send it out on the Thursday, and I do. I usually send it out on a Thursday, but everybody gets you might get a different exam. Not that the exam is structured very differently, but it'll be different questions, or the math problems will be different from one another. Do you follow the idea? It won't be exactly the same exam. That good, Danny? You understand?
Yep.
Okay. Vincent, I'm sorry.
no worries. Is the exams like is it gonna be through Blackboard, or you send us like a
Yep,
PDF and then
I send it to you through email.
oh, okay. Is it like a PDF that we just print out, we can write on it and send it back to you,
Exactly.
whatever?
Actually, it usually comes across as a Word document.
Oh, even better.
Even easier.
Yeah, real easy. All right, thank you. Appreciate it.
Good. All right. Well, ladies and gentlemen, it's now 7:40. We've covered all the issues having to do with the course requirements and such like that. Unless you have other questions, I would end the recording and then ask you not to leave yet. Do you have any other questions having to do with the requirements?